Hello, welcome back. My name is Dr. George Mochocki. You're taking me online, face to face, or a blended class. This is corporate finance. We'll be covering chapter 14, raising equity. Remember, there's two ways a company could acquire capital or cash, for lack of better words, is through debt financing, which is bonds, IOUs, for lack of better words, or in this case, we'll be talking about equity. Equity, we'll be looking at selling stocks or other things of importance that an organization has that they could get money for to sell something off. All right, so make sure you read the book. Where the heck I hit the book? Read the book. The book's a good book. Look at your My Finance Lab. Do the homework. We're ending up. We only have about I think 5 more chapters to cover in this series that we're doing. This is a course offered at a community college, so you're getting a basic understanding. My finance and homework, everything else will be for you to understand the mechanical aspect or the math portion of doing the homework. And this is so you understand the concepts and the terms. I'm going to try to keep this underneath a half an hour. We already discussed this in our discussion board or in our face-to-face class or through the article reviews that all the students will do. And they basically find an article that's current on this topic. And then we try to apply what we've learned from the reading and the homework and see how it actually is applicable to the companies currently now. That's how you learn. This is the best way of learning finance. A little different than accounting is that you could see what's going on and you could identify those areas, and now you're able to implement them into your own organization, or in this case into your final project, which is the company that you selected, that you will be showing how you're going to turn them around and bring the stocks and the value of the stocks of the company up. Okay, so let's go going. I got this at 200, so make sure you have your concept maps. You already read the book, and this is just a quick overview. Real Network. Now, this one here is just a website that the author utilized. A leader creating digital media videos, and it goes to how a company started off. A good link. I provided a link. Look at the link, and then they'll tie in for the rest of the chapter how a company acquired or issued new stocks to get money to fund their operation. Okay, now equity financing for private companies. Okay, sources of financing, corporate investors, and institutional investors. These are all individuals who buy stocks or securities from an organization. Institutional investors are your largest companies, largest investors. However, individual stockholders also buy stocks and everything else. You know, institutions could be for a pension fund or for another organization looking at another stream of income. Okay, so let's look at our sources of financing. You have angel investors, and I'll go through real quickly. Remember, we talked about this in a book. We had the homework problems, and we discussed that in the YouTube and the supplemental videos that I supplied in Blackboard Course Management System. Okay, so angel investors. Let me just move this over so you can read it, go along. Okay, have your concept maps, add on to it. The way you're doing, use my mind maps. You read the chapters, you add on to it, you listen and discuss it in our lectures, you add on to it, you look at the article reviews, you add on to it, and this is your last stage, and all this helps you to retain it in your long-term memory, at least have a general idea what the heck is going on. The book's getting a little more complicated, but I want you to understand the basics, all right? Individual investors who buy equity in small private firms, 100-years-old investors come to Broadway. And this is just tying into the articles that, or the topics that the publisher has, just to tie in this, okay? Now, venture capitalists. Now, remember, angel investors, they basically want some part of the management, what you learn from Intro to Business, or that you've taken in this class or another class. Venture capitalist firm, limited partnerships that specialize in raising money to invest in private equity young firms. All right, just gonna give them a loan. They want something back, a higher return. They're a little riskier, but that's fine. There's people who take the gamble on that. Because the company succeeds, they'll get more money. They'll come back to them for more capital. Okay, now venture capitalists, again, I have that here. General partners who work or run the firms. Okay, now angel investors, now on this one, they may not, let me do a little clarification. They may just invest in the organization, but some of them may have to, remember, the whole thing of finance is terms and conditions. What do these individuals want? There's that fine line. What's considered an angel investor and venture capitalist? Venture capitalists basically are going to be part of the management. Angel investors they'll be like a silent partner, but you may be a little bit too risky, or do you want to have some indirect or input into that. Okay. Okay. Now you have corporate investors. Now, if I look at corporate investors, they're basically a corporate sponsor. Later on, we'll talk about leveraging, buyout, working together, a strategic partner within that within your firm, or a strategic investor on that. Institutional investors may invest directly. Pension funds, insurance companies, endowment foundations may invest directly by becoming limited partners in venture capitals. Remember, limited partners, that means they're not involved in the management. They're just supplying the money for a higher return on an investment. Okay? Now, securities and valuation. We talked about this earlier through the whole chapter. We're coming at the end, and it's kind of now some of this information you're looking at here is what you're going to be using for your final paper. How do I turn a company? When a company's down, having a downward spiral. The issue is, how do I get people to invest in a company so I could buy new equipment, buy new supplies, keep current, update my processes without going to bankruptcy. Sometimes bankruptcy is just another option, not to go completely lose all your money, but it holds back the creditors away so I could do some investment. Were you willing to invest? Are people willing to invest? They may, but they want certain things. Okay, now preferred stock. We talked about preferred stocks, established company, preferred dividend, and seniority in liquidation. Remember, they come after or first. They get paid out first. A new startup sell common stocks. Young startups have seniority in liquidation. Typically, do not pay dividends. I'm a new company. I'm not making money. I'm using the money to reinvest back into retain earnings back into the organization. But preferred stocks, I don't have any voting rights or anything else, but I do pay some dividend. Depends on the investor. Do I buy a house and wait to sell it later and get my return on my capital, or do I buy a townhouse and still have return on capital but got income coming in as a preferred stock guaranteed dividends? Contains rights to convert to common stock. Remember, it's a two-way street. Me as an investor from preferred stock, say I want to become a common stock owner because I see more value in the return of my investments as an owner or voting rights, or I could, but once I convert, I can't come back. Or you may be forced to convert by the company because they're going bankrupt or anything else, and they're going to say, hey, because of the terms and condition, we have a callable option or a converted option in reverse, which basically means we could take your preferred stock and make you stockholder, and now we don't have to give you anything. Okay, now convertible stocks, again, owner has a right to convert common stocks in the future. That's all this is here. Okay, now pre-money evaluation, the value of the firm prior issues outstanding the price of the funding round. So somebody's got to get your underwriters. Here's how much the company's worth. Okay, post, this is pre. This is what I think is value, what I have right now. Post-money evaluation, value of the whole firm, old and new shares, comes all in together at the price which a new equity is sold. And we talked about later on about stock splits and all this. This is just a quick general. Just understand the terms. All I want you to understand the terms. So when you're talking or someone's discussing that, you understand what they mean by pre-money evaluation or post. Pre is before the company actually started, brand new first issue stock, and post is after they start selling additional stocks and everything else. So you have new stock and old stocks, and they're trying to get more money. What's the value of the organization? Okay? Okay, exiting and investment in a private company. Details show how to eventually realize it and basically return for the investment. Two ways to exit: acquisitions or public offering. Process selling stocks to the public for the first time, IPO. Okay? Taking your firm public, and here's the book. It's advantage and disadvantage of going public. Some of the advantages: better liquidity, better access to capital. You don't have to take a debt. You're not at home, but you have more shareholders, people who are interested in your organization that have a voting, through your proxies and everything else. But so you're kind of tight because you're not. It's like, look, when I owned my own house, when I was single, I could do whatever I want. When I'm married, I could still do whatever I want, but I have to ask my partner or my wife. Or if you're living with someone, or you come into partnership, or you're with another individual, you basically by yourself, you make all the decisions. Now you have another partner. Now it's going to multiply that by thousands of different shareholders. They've got some input in what's going on with the organization. Some of the disadvantages is big equity holders more dispersed. Okay, must satisfy requirements of public companies. Other companies are involved and they have their input. Hey, I don't want you to do this. I don't want you to expand. I don't want you to go into this market. I want you to stay here. I want you to grow. Whatever. That's all part of when you have shareholders. You have more people in the pie. You have more people to have the input. Same thing with our democratic Constitution, or right here, if you look at it, whether you like Trump or not, he was elected. He had the majority of the electoral votes, give or take. You know what I'm talking about? So he's the president, so he has to follow. Down in the elections coming in, you don't like his procedures, you don't like what he's doing with the economy, you don't like blah blah blah, whatever. You get rid of him. The same thing with what happens when your board of elect your board comes up for election. You basically could eliminate half of the board and bring in new management, or like a new president, for lack of better words. So look at the electoral college as the board, the corporate board that basically says yes, these people, shareholders, elect the board, and then the board basically, or electoral college basically says, okay, here's who our next president is because he won the majority. Because that's the board of directors. Do you see how that works? Look, you look at the U.S., it's similar. It's not that rocket science. Once you understand our concept, what's going on in the government, you could kind of take it over and understand to see what's going on in corporate America. Okay, now your spread. Fee a company must pay to its underwriters. Remember, underwriters going to say yes. You do have the assets. You did it. We did all this. Blah blah blah. And but here's the fee. They're not doing it for free. They're doing it for something else. Something when you go for a mortgage and they check out to make sure that your house has no liens against it. They're not doing it for free. You're paying a fee for that. Okay. And over allocation, green shoe provision allows underwriter to issue more stock, usually 15% of the original, had that spelling, offering of the IPO. I could offer more than what the initial public offering is worth by 15%. That's just the rules, okay? Okay, now lockup restriction that prevents existing shareholders for selling shares for some period, 180 days. It has something to do with the company doing something so you don't get rid of it, so it gives the company enough time to make the adjustment so you're not running, getting rid of the stock so you know what they're doing. And remember, shareholders are going to say, the stock's going down, let me get out of here also. So it gives you that breathing period and say until it kind of stabilizes. Kind of good, a good provision if you look at it. Remember, I'm just giving you a real quick, simplistic version of it. The book goes into more detail. The exercises, our discussion. This is just a quick overview so I can stay underneath my half an hour. Okay, primary and secondary IPOs offering. Okay, primary offering basically is new shares to the public to raise capital. Preliminary prospectus, part of the registration statement prepared by the company prior to an IPO, initial public offering, circulated to investors before stock would hearing. All right, we'll talk about that later. Final prospectus, a final registration statement containing all the details, number of shares for sale. The underwriter, basically investment bank, credited. He looks at it. He's kind of like an insurance. If it doesn't go on because some of the numbers are wrong, you at least have some kind of avenue to recoup what you've lost. Usually it doesn't happen. You know, legal underwriter is a primary firm responsible for managing security insurance. They say, hey, we secure this, we stamp this, we're all right. Anything happens, we'll be liable for that. Syndicated, there's a group of underwriters who jointly underwrite and distribute a security issuance. Okay? Okay, registration statement provides financial and other information about the company prior to the security issuance. A roadshow is senior management and underwriters travel to promote the stock. You see that with some of the tech companies that are going on there. Facebook went through that. Twitter went through that. So you're looking. Institute. So you're looking at to go out to the show, so you understand here's the individuals who are running this, and now me as an investor, we kind of feel comfortable. And then you have the underwriters and insurance company underwriters that are basically saying, yes, we vouch for this individual. He does have this idea. We think it's a good idea, and we'll back this idea for initial public offering. The company goes on. Whether it fails down the road, okay, they're just telling up front here, this is a solid idea. They have the assets, they have the copyrights, they have everything else they need on that. Okay, now when I look at secondary office, equity found shared sold by existing shareholders as part of an exit strategy. All right, well, we went through a lot here. What do we got here? Okay. Okay, now other IPOs is best effort basis. Smaller IPOs, underwriter does not guarantee the stocks will be sold, but tries to sell the stock for the best possible price. They're not insuring them, but they're still they're like the realtor doing the house. It says buy as is, for lack of better words. There's no insurance, no guarantee. You buy it as it is. The building I bought. My first this home that I bought here, I bought as it was run down. Very run down. Had a lot of work to do, no insurance, everything else. But I got a good deal on it. But then I invested it, and now I recoup my investment way more than what I invested in it. Okay. Now auction IPO is one method of selling. One method for. Remember, I'm live. Those who have me, I don't change. I don't edit. I'm live. This is why I do my correction. For selling new IPOs, initial public offering, directed to the public, with market determine the price, two bids, and potential investors. Auction. Here's the house. How much? Remember, when you have the auction, they have a starting price, not like starts at zero. They already kind of know here's the starting price for the shares, and then hopefully it'll go up higher and higher because people say this is a good investment, or they may keep it at starting price, or they're gonna just close the auction off. Similar like you would do if you ever been in an auction for property. There is a starting price on it, or for a car and everything else. Okay. Okay, IPO puzzles, underpriced IPOs on an average. Oops, let me just come in here so you guys can see that. Guys and girls, excuse me. Who wins, who loses because of number of pricing, hot or cold market, number of IPOs. Let me just do this. Let's just do this. I do my corrections and I don't have to do it later on. Okay, number of IPOs is not solely driven by demand for the capital. Other times firms appear to rely on alternative sources of capital. Sometimes the firm's an investor for favors IPO. Remember, you're looking at the investor. They got a good idea. I like this person. I'm going to take a gamble on him or this company or this LLC or this S corporation or well, in this case not S corporation but this corporation, for lack of better words. High cost of issuing IPOs is U.S. The discount below the issue price. Underwriter purchase shares from the issuing firm at 7% of the issue price. Underwriter's always getting the shares. Remember, they're buying it, and now they're going to try to sell it. That's the bottom line. The underwriter buys the shares at a discount and sells it out because they're guaranteeing it. But they're looking at that they're going to make some money on that. So everyone is satisfied. Who's going to say George is a GAM Consulting Corporation? You know, I'm an LLC, but if I was a corporation, this is what I'd be. Who'd trust me? I'll buy your shares and I'm going to try to sell it for you. I'll take the gamble. I'll take the risk on that. Okay? Poor post IPOs, long run stock. Newly listed firms appear to perform relatively poor after the following 3 to 5 years of the IPO. So they had a good idea and they're stuck with it. All right? It happened. Come on. You're taking the gamble. Stock market is kind of like, I don't want to say gambling, but it's a calculated risk. And any kind of risk, it is kind of a gamble. You're going to say, will I make money or will I lose money? It's you do your research, you do everything else, and you say, I think this works. Some companies will be very successful. Some now it depends what the market, depends what the product is selling, depends what the service is selling, depends what idea they have. Will the consumers actually buy? When companies start going down, look at Kmart or Sears, is consumer lost confidence in a product, or other competitors came in and had a better product. So the stock drop. No one's buying it. How am I going to get the stocks to go up? I got to get consumer confidence back in. I got to revitalize myself, or do something as an organization to bring that value of the stocks, the value of my company, my product, my service to the individuals who are utilizing it, and then the stockholders say, hey, I see this company growing, I'm putting money. Or I find another market overseas, or I rebrand myself and come up with something differently. Okay, that under performance and it might not result in the issue of equity itself, but rather conditions motivate equity insurance in the first place. Okay, what else do we have? Oh, well, I'm going to make it underneath a half an hour. Look, I know I'm going very fast, so this is just an overview of what we discussed, what you read, the homework and everything else is just another way of, now it all makes sense. Instead of making it real complicated, I simplified the whole thing. Remember on this. Okay, so you have season equity offering, basically is firms return to equity markets and offer new shares. Okay, so equity offer new shares for sale. Like I want to say like initial public offering, but it's a seasonal. They just add more. Remember, a corporation is keeping selling stocks more and more, and we discussed that in previous chapters and stock splits. Another reason for the pricing on that. Okay, the process is when a firm issues stock using the seasonal equity offering, it follows the same steps as for an IPO. Main difference is the price setting process is not necessarily since the market already sets the price already exists. Okay, primary shares, new shares issued to a company for equity offering. Secondary shares, that's a secondary market. Shares sold by existing shareholders, equity offering. Remember, company can buy back. People are buying, people selling. The company is issuing shares also at a lower price, and or at a higher price, and you may decide to sell yours because somebody else is or at that price. So there's a lot of activity going on, but it's no longer the company or underwriters setting their price for what is, other than the auction, is what is worth. The seasonal equity offering is basically looking at the markets already determine what the price for the shares are. Now the company needs more equity, and they have to go with the market price. It's no different than when you take your SAT test. You're at my high level, but then you go to community college, and then you're average or below average student, and now they don't look at that you have scored high in the SAT test. It's just an indicator, an assessment. They say when you actually went to college, you're not doing too well, so you can't take the material, you can't do the lecture, you can't do the homework and everything else. You're good test taker, but not. And the same thing happens here. I'm just trying to bring you examples that are utilized in the classroom as to tie in the concept so you know what's going on. So when you're doing an SEO, a seasoned equity offering, you're basically selling new shares, but you have to consider what the market is offering. Same thing with college. If here's your test, they don't look at your SAT test. They may look at it, but it's not a main factor, it's a secondary factor, and your actual performance is what the main factor is, or the primary market. Okay, now tombstones are basically a newspaper advertisement in which underwriters advertise a security issuance. Cash offer is firms offer new shares to investors to either buy them back, or they do a split stock or do something else on that. Remember, we discussed that in the reading, in the chapter. Quick overview, just so you know. The right offer is uh, shares. Did I get that right? Yeah, shares equity offering. Did I get the? I just want to make sure that I'm dyslexic, so I sometimes turn around the acronyms around. Um, I did turn it around. I knew it didn't look right. Shares equity offering. I was going to say, man, there's a new concept I didn't even know. My error. Shares equity offering to new shares only exists to existing shareholders, and that's through stock split, and so they could either lower the prices of what the market is. They're not lowering the price of the market; just giving them more shares so they can sell the new initial public offerings at an affordable rate because the market price is way too high, and most people can't buy them in shares, so they break it down. Something like a Bitcoin right now. What's Bitcoin going? One Bitcoin going, I think, like $10,000. But you could buy a little piece of the bitcoins or convert money into a bitcoins through it. There's a company called just try. I'm not trying to sell it. PAOS, and they basically, this organization, for a fee, or a very small fee, and some companies that's all they deal with the Bitcoin. They basically will. You give them, I need something for $80, but I need a Bitcoin to do a conversion. You don't have to buy one share of Bitcoin that's worth $10,000. You just get a piece. It's like I got 10,000. I got $100 bill, and I just want change. I just want to buy something for $2 worth. So they'll convert that over to me in a simplistic way. Okay. Are we good? So now that's everything we had, and I think I'm doing pretty good at here. Let me just bring this down. Oops, sorry. So I can have a closure on here. Expand, first level. All right, there we go. We covered everything we wanted in here. So this is our chapter, doing equity. Remember, equity is, if you look at what's going on with the Trump administration, whether you like President Trump or not, his administration is still here for a couple of years. They're trying to do is bring the U.S. out of being a debt debt, DEPT type of structure where we borrow, and, invest, and always you get a better write off on your taxes because of your expenses, and trying to bring you into an equity type that you're paying cash or coming up with a product or selling and bringing more investors in, and not issuing bonds or borrowing, and get out of that thing. And how does he doing it? How's the administration doing? For lack of a better word, they're basically giving you less and less write off on your expenses and giving you a better return on your capital. So companies, your accounting and finance, say, okay, here's where the administration is going this way. If he wins in 2020, right now the odds are that he may probably win because of good economy, strength, and everything else. Hey, don't look at me. I don't agree with everything he says, but I'm a business person. I'm a finance person. I'm going to say, what are my odds? The odds are in his favor. Forget the polls. The polls are all, the polls are too early now to tell. Depends what's happening closer when that voter comes in there. What's he doing? What did he do right? All right? Right now he's doing pretty good with China again. Even though the tariffs are on there, he's bringing money into the economy, pay off some of the debt. So he can say, look, I brought down the national debt to tariffs, and now, but the trade agreement with China is going back again. They're talking again, so now the investors have a good confidence. The farmers and everything else. Look, all I'm doing is you have to be current. I got the Wall Street Journal over there. You have to be current to what's going on, and you're making these assumptions going forward. Things could change things could change tomorrow. All right, but I gotta look. I gotta be a pessimist, looking forward, optimist, for lack of a better word. Okay, the economy's going good. The economy's been doing good for 2 years with all this other stuff going around with his administration. He's moving the economy into the right direction. You may saw just a trickle effect on the economy, but the shareholders are feeling confident. The businesses and other countries say, hey, we'll invest in the U.S. companies because their economy is strong. Ours is weak. I'm going to move our money, our euros, everything else, and we'll start buying shares in the U.S. That's what happens in a global. I'm not saying globalization. Everyone's the same. I'm saying in a global market. A little different. Remember, all nationalists. A lot of even Russia's nationalists. China's got its own thing. But they sell on the global market, and I'm going to invest where I want. All right, so right now people may go keep their companies back in China because they say, hey, there's a trade balance. They may settle this, so I'm not going to pull out of China. Or will I? Or maybe just to be on the safe side, I'll start pulling maybe instead of all of my ventures or manufacturing out there, maybe a third. Look, I'm a finance person. I have to make this decision in the next 2, 3 years so my shareholders are making a return on their investment. Otherwise, they just put it in bonds or golds or commodities. All right. My name's Dr. George Mochocki. I hope this worked out well. Let's see how many minutes I have. And I'm at 27. I need a half an hour. All right. So it's pretty good on this chapter. Look at it, do the reading, do the homework. And this is something that you will need to utilize for your major paper as a team that you're going to be presenting in this class. And it's a good way. Remember, it's easy to read about this stuff. It's easy to do the math. But now when you have to come up with a plan. You have to come up with pro forma. What's my income going to be? What's my exceptions going to be? How much should I invest? All this is stuff that finance is doing. You're taking the risk. And then later on, the companies you selected, and then after you came up with your idea, follow it down the road. Remember, you're getting some idea what's going on in the market, what people are saying, but down the road, you say, hey, man, I was right on the money. I know it. I understand. And this is one way. So when you understand what's going on in our organization by what they're doing, what's happening in the economy, what the forces are happening with the Federal Reserve or different banking systems and everything else, and regulation, and now you as as a stockholder could say, I'm going to invest in shares, I'm going to buy some stock, or I'm going to go in bonds, or I'm going to go in commodities. You are able to make that decision. You got the information. You don't have to be a rocket scientist, but you have to see what's going on, and you got the puzzle, and then your intuitive or your critical thinking idea concept, you'll be able to purchase the right shares or take a risk on some organizations or some companies or some stocks that are out there. It doesn't have to be in the U.S. You could go into European Union. They're having a lot of problems. They're having more taxes, regulations, everything else has been put on them. They got a lot of the taxes, and a little unsettling. You know what I mean? So wait. Hong Kong, the same thing. What's going on with Hong Kong and China? I don't know. I invest in some of their markets there because they've got their own exchange, or do I pull back? Or am I invest? Say I'm going to be there for 3, 4 years, make some money, get the heck out of there before if I see it's turning on the wrong way in that. That's how you do it. So this class is not only how companies have to think, but it's also how you have to view and look at different parts to make a decision what stock I keep. Do I hold them or do I fold them? All right, my name's Dr. George Mochocki, and sign up for my class. I teach at community college or some other community colleges. They give you a good basic understanding. Then we go for your bachelor's and your master's and your PhD. We just up it, and more variables, more rules, more formulas. But right now you got the basic understanding. You understand the basics, you could work up on in the organization. And so when people are talking and you're moving up the corporate ladder within your organization, is going up, you at least understand some of the language they're saying and concepts. All right. Talk to you later. Have a nice day. Bye.